And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Hi, I'm Lance Roberts, and it is The Real Investment Show, of course, and it is Labor Day, so we want to wish you a very happy Labor Day, but hey, we're not leaving you hanging today. We have a very special show today of some of our best investment strategies, risk management techniques, etc., to help you manage your portfolio better. So while you're sitting around and having a great lunch today for Labor Day, you can also get a little bit of education. Thanks for joining The Real Investment Show. We'll see you back here live tomorrow for the next Real Investment Show with Lance Roberts. Have a great Labor Day. When you think about managing your portfolio, there's kind of, and these are listed in the article today that's on the website. So if you go to realinvestmentadvice.com or go to my Substack account at Lance Roberts, I've also posted the link on Twitter at Lance Roberts. So wherever you want to find me, you can find me. But I've kind of posted out 10 rules, and these are very basic, right? Just, trim your most extended positions, rebalance towards quality and defensive sectors, maintain and increase cash cushions. There's nothing wrong with doing a bit of risk management. You don't have to be like number 9. You don't have to be fully allocating your portfolio all the time. That's what Wall Street wants you to do. Wall Street wants you to be 100% allocated to stocks all the time. Why? Because they can charge you on that. They can't charge you on cash. So if you're 100% allocated to stocks, they can charge you a fee to manage your money on your whole account, right? So they want you to be 100% allocated. They always tell you, you got to be in the markets. Number 10, I think is very important. Employee conviction, right? Limit frameworks. Set maximum exposure thresholds. One of the things that happens in portfolios is that we get too optimistic. Again, we as we said earlier, we have a tendency to forget the previous pain that we had in the portfolio, right? We forget the March, April 20% corrections. We forget the 2022 declines. We forget the 2020 35% drawdowns. We forget those things because those are painful memories. We don't want to think about them, and we assume that they won't happen again, but they will happen again. So, this is why it's important to monitor your position. Monitor those metrics. We talk about position sizing in the portfolio. And the way to think about position sizing is that I'm going to buy this position, whatever it is. Always assume that position, no matter what you're going to buy, assume the position goes to zero. And you go, okay, so if I'm going to invest, look at your portfolio and say, okay, if I'm going to invest X into this portfolio into this position and it goes to zero, what does that mean for me? Does that change for me dramatically the outcome of my portfolio? If I put X dollars into this and it goes to zero, what does that do for my whole portfolio? And as long as you can live with the tolerance of that going to zero, I'm not saying it's going to. I'm just saying assume it does. If you can assume that if that position goes to zero, you're still okay, then that's a good size. And if you, I talked about Michael Colville's and book on turtle trading. It's a great read. But all the great traders, they use position sizing. And so you look at a position in your portfolio, you size it, say 2% of your portfolio is this. If it goes to zero, I'm okay. It's 2%. Think about it this way. I have a portfolio of 10 stocks. 100% of my portfolio is invested in 10 stocks. That means each stock is 10% of my portfolio. If one stock goes to zero, which, by the way, can happen, right? That is a pretty big impairment to your overall portfolio. So that's just the way to think about it so that you can size your position, size your risk better. It also helps with diversification. Works the same way through diversification. If I have all my money in this sector, right? So right now I've got 50% of my money in technology stocks. What happens if technology has another DeepSeek moment? What does your portfolio look like relative to the markets? Again, at the end of the day, what our goal is to try to grow our money at a rate of return over time to meet our financial goals. And if we take on too much risk and something goes wrong, which it does occasionally, and we should expect it to occur, that can set us back from our goals a good bit. And again, that's the thing that we're trying to avoid. It's easy, and again, it's very easy to get all kind of wrapped up into this kind of market hype and kind of analysis that we get because of the media. Everything's just being fed to us every day through the media, through the red and green flickering lights on our portfolio page. It's all great. But there are risks out there that we are either ignoring or overlooking or just ignoring entirely. One of the things is what's going on behind the scenes with economic growth. In order for earnings to grow at the rate that we're currently growing earnings in the markets, which is fine, we have to expect that economic growth is going to follow suit. So if we're expecting 15% earnings growth next year, which is kind of on the books right now, you can't have that rate of economic growth, of earnings growth without economic growth. The IMF just posted out their latest projections for 25 and 26 by region. It is expected that in 2025, the U.S. economy will grow at 1.9% versus 2% in 2026. That rate of growth is not strong enough to support earnings growth at 15%. Because earnings growth comes from economic activity. I need that chart back up, please. But more importantly, I want you to take a look at what's going on in the Euro area, right? So right now, everybody's like, oh, you need to buy Eurozone stocks because Eurozone stocks are cheap relative to the U.S. They are not cheap. They are not cheap when the Eurozone is expected to grow at 1% and 1.2%. They're growing half the rate of the U.S. So where's earnings growth going to come from? Those are not cheap stocks. So investors are taking on a lot of risk on a wrong assumption. Yes, the stocks are cheap on a valuation basis relative to the valuation basis of the U.S., but the U.S. has economic and earnings growth. Eurozone does not. They're not cheap relative to themselves. And this is important because if we take a look at and take a look at what's happening, right? The Federal Reserve is talking about cutting rates in September. Why is the Fed cutting rates? Just to support the stock market? No. They're cutting rates because the economy is slowing down. We see that in employment, retail sales data, CPI, et cetera. We're all seeing the evidence that the economy is slowing down, so the Fed's going to cut rates. Well, while the Fed's cutting rates here, global central bank policy is cutting at the fastest rate since 2020. So if things are so great in the Eurozone and we should all be piling into Eurozone and international and emerging market stocks because those countries are apparently doing great, why are they cutting rates at the fastest pace since the pandemic? See, this is where we've got to get away from the narrative and get into the fundamentals and start understanding that, yes, there's a lot of momentum chase right now. And so we need to be aware of the momentum. We need to pay attention to the momentum. We need to understand the momentum. But we need to be very careful in understanding what drives earnings in the future and what we're actually basing our forward expectations on. And this becomes the problem when you have a very, very bullish market environment like we have now, because all of a sudden, we forget about these things. It's like, who cares? Markets are going up. Who cares if I put dishwashing soap in my dishwasher? It's all fine. Right? But the fundamentals will eventually matter. And when they matter a lot. And that's the risk that investors, typically take. But right now, again, we go back to that data and we look at expectations for earnings growth, and it's just kind of just soaring out into the ethersphere. We're just very optimistic about earnings growth. Again, you look into the first, second, third, and fourth quarter of 2026, just a massive surge in earnings. Well, where's it going to come from if the economy is slowing down? Now, maybe we're going to, maybe we're going to have this massive surge in earnings and economic growth. And if we do, fine, those are justified. But right now, based on the data, it's hard to justify double, 14, 15, 16% rates of earnings growth in an economy that's growing at 2%. It just doesn't really jive. But, we'll see kind of see what happens. These earnings down, bring that chart back up for me real quick. If you take a look back at 2023, nobody was expecting a downturn in earnings growth. If I pulled this chart for going back and I showed you in 2022 what 2023 expectations were, they look like 2026 expectations. Oh, we're going to have 15, 20% economic, earnings growth. And then we didn't. We had negative earnings growth. See, downturns in economic and earnings growth is never anticipated by Wall Street. So when you're banking on these types of analysis, you go, okay, well, I can buy stocks today at 22 times earnings because based on forward earnings, I'm going to grow into that valuation. Wall Street never anticipates a downturn in earnings or in the economy. It's always optimistic. Why? Because they're trying to sell you stuff. I can't sell you stocks and go, hey, here's a really great stock. You need to buy CoreWeave because they're going to lose a lot of money over the next month. You never hear that, right? They've got to sell stock to you, so their outlooks are always optimistic. I showed you all that study previously from the Wall Street Journal, and they went and they surveyed Wall Street analysts, and they said, what's most important to your job as a Wall Street analyst? My institutional investors, appeasing my corporate investors, accuracy of my predictions was at the very bottom of the list. Who's your most important client? Institutions, corporations, other fund managers. At the very bottom of the list, retail investors. If you haven't figured it out yet, you're the cannon fodder for Wall Street. You're the dumping ground for everything. IPOs, SPACs, you're the dumping ground. So when you're told, hey, this is a really great investment, you need to buy it. Okay, why now? Why didn't you come tell me when they were private? And see, this is why there's a big push right now to bring private markets to public markets. So you can put it in your 401k plan and you can get in all these spectacular deals while they're still private. Sounds great. Except the problem is that you're not going to get the really good deals. You're going to get all the deals that they passed on because they're going to keep the good deals for themselves. The BlackRocks of the world, the KKRs, the Sequoia funds, they're going to keep all the deals that are good. They're going to give you all the chaff that nobody wants. And you just need to be aware of that. But they need more places to draw capital from. And when I can't draw capital from smart investors or smart money, as we call it, where do I go to? I draw money from dumb money. And that's you. That's not an insult, by the way. It's just the way it's categorized. I'm not saying you're dumb. I'm just saying that's the way the market's categorized it. Retail investors are considered dumb money. If Wall Street considers retail dumb money, it really tells you all you need to know, right? So just the whole point of today's conversation, I'm going to wrap it up here. The whole point of today's conversation is that there's a lot of bullish sentiment in the markets right now, but it's being driven by a narrow framework of markets. It's being driven by a very narrow group of stocks, and that leads to more risk that you're taking on, and you may not be aware of it. And that's why I laid out these 10 kind of guidelines for you today. They're in the article. again, are on the website this morning. So again, just go pull that article, look at those 10 guidelines. It'll help you kind of think about, and again, these aren't rules. These are guidelines. So they're just there to help you think about your positioning in the markets. And how you're positioned, I don't care. You can be 100% crypto, 100% gold. I don't care how you're positioned. It's whatever makes you happy. But at least these 10 kind of rules or these guidelines can kind of help you think about your positioning and say, okay, maybe I have some excess risk here. Maybe I need to have a little bit more cash or whatever it is to help mitigate some of that volatility risk that can come up in the future. And again, it will come up. It's just a function of time. It's not going to happen today, may not happen tomorrow, may not happen next week. But we're eventually going to have another bout of volatility. And again, we forget about those periods of pain, but we're reminded of it very quickly when those things occur. All right, good morning and welcome. Of course, it's a Real Investment Show. Today is Two Dads on Money. So John Penn and I are going to talk a little bit about, a couple of things that we've been talking with our kids about in particular. And one of the fascinating things, and I actually had this conversation with my daughter as well just the last couple of days, and because she was asking me, she's like, I got $300 in the bank. What am I going to do with it? I go save it for college. But she's like, I heard on TikTok, right, that this is what I should be doing, and it's kind of an interesting thing because, again, just from a financial perspective, there's so much information out there on the internet, whether it's TikTok or Instagram or whatever, right? Yeah. Chat GPT. Again, look, and Chat GPT is kind of a cool thing because you can come in and say, tell me the 10 best stocks to buy, and it'll rattle off a whole list of stocks to buy. And and you would think that that's good advice and that it's well researched and all these type of things. But the problem is that it's just kind of looking at the knowledge base of the internet, which is fine. That's a lot of knowledge, by the way, and it's drawing the answers from what everybody else is saying. So again, it's this. The one thing you've got to be careful of is kind of this group think that goes on in the markets. And again, this is the herding bias. It's what happens. And again, when everybody in the internet's talking about Palantir and Google and Amazon, then that's the stocks that it's going to recommend. It's not doing deep research and saying, hey, this is an emerging company that's going to do well, and here's all the reasons. And so it's important to make sure that you're not just relying on artificial intelligence to give you that information, because all it's doing is sweeping you right into what everybody else is doing in terms of the herd.
Yeah, the social media, all that information that's put out there, whether if it's Facebook, TikTok, YouTube, you name it, it all quote unquote, it looks really good. It looks legit. So I think it's easy to get drawn into all of that. So our daughters are 23 and 25, or so our youngest is 23, oldest daughter's soon to be 25. So I asked them, I said, hey, I said, do me a favor, just ask your friends if they're going to search for financial help, they're looking for financial guidance, would they rather turn to social media or would they turn to an actual financial advisor? And it was interesting about the responses. One of the responses from one of their friends was, I'd ask an advisor, but with the amount of social media outlets out there, the average person would turn to social media. AI like ChatGPT is becoming popular for financial tips, especially trends in the market. Then there was a comment, though, that the same person made the comment, I feel like every social media expert, and that's in quotations, is trying to sell you something.
Yeah.
Right, so basically it was watch out if they're trying to sell you a book or a course, or they're trying to get you enrolled into something right now to take advantage of what they're talking about. Right?
Well, and again, that's the thing that's with the internet in particular, especially like TikTok. It's like everything is, hey, this is what I'm doing, blah, blah, blah. Oh, there's a link in my TikTok shop, and everybody, and again, it's great, right? I mean, everybody's figuring out a way to maximize social media and start creating, these other income streams, et cetera. And again, every other creator on the internet is, hey, here's how I make $40,000 a month. Listen, if everybody was making $40,000 a month off the internet, we wouldn't have the top 1% of the country owning 90% of the stock market, right? It's you wouldn't have the average income of America wouldn't be $65,000 a year. You wouldn't have everybody living kind of paycheck to paycheck, which is what we know from the actual statistics that we measure. If everybody's making 40 grand a month off TikTok, right, it'd be great. It'd be great because we wouldn't have to worry about AI because everybody would be making plenty of money. You wouldn't have to work. But you just have to be very careful with again. And I'm gonna there's this financial TikToker, right?
Yeah.
And I'm sure she's really smart, right? But her shtick is that she went from $40,000 in debt in her 20s. So do the math here.
Mm-hmm.
So in her 20s, early 20s, she's $40,000 in debt. In her now she's now in her early 30s, and she's worth 8 figures with no debt.
With no debt.
Right, and so she's giving out, dispensing financial advice. Oh, just stick your money into a Roth IRA, and the financial advice isn't bad, right? Invest in a Roth IRA. Put it in an S&P index fund, let it compound for you. Just add 75. That's all great. That does not get you from $40,000 in debt to 8 figures in 10 years, right? That's not how that works mathematically. So again, it's how she got there. I think that, in my opinion, is she was buying and selling real estate, which you could do it that way if you kind of hit it right. But again, going from $40,000 in debt in your 20s to 8 figures, it's all fine. I'm not saying that it can't happen, but you have to be careful that the information you're given, right, isn't going to get you to that level in 10 years.
Right.
Right.
Yeah. Or I don't know. I think there's an allure to it. Some of her daughter's friends said that, social media, it's easy to access. Mm-hmm. It's free, kind of the most used search engine as of late for financial media or financial tips, ChatGPT. But then I asked them, what are some other platforms that they use? TikTok, YouTube, Instagram were a couple, and apparently. And I said, well, why is that? And the response that I had from our youngest daughter's group of friends was, it's just our generation, and that's what we're drawn to. And that's kind of the meat or the substance that I received, right?
Right.
So I think, to your point, Lance, there's probably some very sincere, legitimate, online, YouTubers out there that are really trying to help people. But you got to kind of be a little bit leery around what's really behind the message that they're, what's behind that education? Is there some sort of an ulterior motive at the end of the day to put revenue in their pocket, right? And I think like the influencer that you were talking about, to be $40,000 in debt in your early 20s and then have 8 figures in your bank within 10 years. That's just. I hope it happens to everybody, but that's not the norm.
Right. Right. Yeah. And that's the again on TikTok, social media, all these different platforms. There's a lot of people out there dispensing financial advice, and they're not registered, they're not licensed. And again, that doesn't mean anything, right? Just because you've got a license or a registration, it doesn't mean that you can't give out good financial advice. But there's also, just understand, they have no risk, right? So for John and I, we're fiduciaries for our clients, and so we have a legal liability to provide the best advice for our clients. And there's a we can go to jail for doing, and some of the stuff that you see on TikTok, etc. These are people just dispensing financial advice, telling you what to do, which is fine. Again, there's no problem with that, but they have no legal liability behind that. There's no risk to them if they're wrong. And so if they wind up costing you a ton of money, or worse, there's no risk to them because they're not registered. There's no oversight, etc. And also there's just a function of time and experience. A lot of these people that you'll see on the internet, they're young. They're day trading stocks, telling you, oh, buy this crypto, or here they're day trading as penny stocks on their screen, while they're live streaming their trading activities. That's all great. We're just in the market for that right now. What happens when this market turns? And it will eventually, right? And one of the things that concerns me is that, a lot of this advice is suggesting that there's a fast way to get rich in markets, or actually a fast way to achieve wealth, which is through investing, which is part true statement. Yes, you can build wealth by investing and doing it correctly over time. You might get lucky and hit, the meme stock that makes you a lot of money overnight, but that typically winds up turning into big losses at some point as well. And again, we just went through what's fascinating to me is we just went through this whole episode in 2021 and really 2020 and 2021. In fact, there was a TikTok couple that came out in 2020. I have a video of it that I put in an article, and they said that here's how we invest. We buy stuff that's going up, and then we sell it. And that's how we make money. And of course, that completely blew up in 2022. And unfortunately, we're back into that mindset. And again, and a lot of those videos went away in 2022. You didn't see a lot of that activity in 2022. And now in 2025, we're seeing a lot of that activity coming back, where people are saying, oh, just buy this because it's going up. Here's a chart of this, look at this. And some of this is pump and dump schemes. If you notice that some of these stocks are very low dollar amounts, they're $1, $3, whatever. American Eagle Outfitters is a good example of that just recently. These were very low dollar stocks, and they got hooked into this kind of meme stock trade. And yes, as long as you're the one selling on the way up, it's fine. But it's what it's doing is luring a lot of these kids in to invest capital and without understanding when to sell it. And that's kind of the problem that comes is eventually this breaks, and there's going to be a lot of young people that lose a lot of money.
Yeah, because we find that, not just even the younger generation, but folks even my age, right? I'll be 51 later this year. I find that there's just a lack of understanding out there about how the markets really work, and I think there is a real push to try to quote unquote educate the younger generation around, this is how investing should be, kind of the get rich quick. You should be able to turn $500 into $50,000 overnight or within a week. That is not long-term investing, right? It's not a process, and so there's a real, I find this a lot, especially with the younger generation, there's this real allure for, and get rich quick should be easy. It should be the norm, and that is just simply not the case. And my fear is that too many people are going to get burned through that. While I think it's great to have education and different perspectives out there on various media outlets, whether if it's YouTube, TikTok, X, you name it, Meta. But if there's something I can at least just mention this morning or with our time together is, folks on social media, they don't know you. They don't know your situation. Like Lance mentioned, the whole team, we're all fiduciaries here. We have to put your interests ahead of our own, and that is not something that we take lightly. So part of that wealth building process is truly getting an understanding of how you are as an investor, what is your family situation, what are your goals, risks, objectives, all of that boring stuff that us planners like to talk about. But there's a lot that goes into that. And my fear is that there's just this, throw your money into this investment and it should, double, triple overnight. And you just do that without, ever losing money. And guess what? In 10 years, you're going to have eight figures behind your name. It's that easy.
Yeah. Well, yeah, that is also kind of a revival of a movement that we saw, and I wrote a bunch of articles about this called the FIRE movement. You remember this?
Mm-hmm.
And there was this guy that was on the internet, and he created this whole thing called the FIRE movement, which was financial independence, retire early, was the goal. And it kind of pushed a whole generation of people. Look, it was well-intentioned. It was a well-intentioned movement, which was basically live well below your means and save a bunch of money and invest it into index funds and then get your cost of living down as low as possible, and save up $300,000 or $400,000, and then that $300,000 or $400,000 growing at 8% a year would generate enough money for you to basically be independent, and you could retire early. And the whole goal was to retire in your 30s or 40s. And and so we saw people like they were packing up their van and converting them into living vans and going down, but they were going to live their van down by the river.
Is that Chris Farley?
Yeah,
that's been done. This has been talked about before.
Exactly. And it worked great when the market was doing fantastic, right? And it was like, hey, well, we're making all this money. It's great. I've got my $300,000 and I'm making 10, 15% a year on this. It's awesome. And so we saw this whole movement, and then when the markets, collided, a couple of things happened. And this whole idea of retiring early is great in theory, except retirement is boring. and we have this idea that being retired is great. I can just do whatever I want, go wherever I want, sleep in, just play video games all day, whatever. There's humans need something to do. They need to be productive. And so you talk to most people that retire early, they eventually wind up going back to work or doing something because they just literally get bored. And the problem with this idea to retire early is two things happen. So a lot of these people that went into this financial independence to retire early, they did it. In fact, the guy that wrote the article is now back working because he found out the other side of this. Well, and then also too, if you have money saved up and you're living on the income from that coming in from your investments, all of a sudden your investments take a big drop, then that becomes another problem. And now not only do you not have enough money to live on, but now you've lost your skill set because the world has kept moving forward. So if you were a computer engineer 5 years ago and you've been retired, you come back into the marketplace today, all of a sudden the world has passed you up because of AI, and your skill set is now outdated. And so it's going to be very hard for you to get back into the workforce at the same level you were previously because of this big gap in your employment. So there's a lot of detrimental effects that come out from this type of idea that I'm just going to retire early, is you've got to be careful of. But market volatility is the one thing, and there was an article this yesterday on Market Watch talking about Gen Z plans to be financially independent by 32 without relying on a 9-to-5 job. And this is a little bit of the same idea as the financial independence retire early thing, which is just, this is the new version of this, which is I can now speculate in the markets, or I can do, give out advice on TikTok and get paid for it. I can do this kind of alternative advertising. I can create a TikTok shop, and I can do Amazon reviews, and I can get paid for all. And look, those are valid income streams, right? You can go do reviews for Amazon, but everybody's doing them, right? And so, yes, and with any business, whether it's like our business, in our business, the average financial advisor makes around $80,000 a year. There are few, the 1%, that make a lot of money being a financial advisor because they've built a book, they have a really strong practice, etc. That's any business. In any business, you're going to hear about the people that, this guy YouTube streamers. There's YouTube streamers, Mr. Beast. He makes $100 million. I don't know how much I don't know what his gross income was last year, but it's over $100 million. This guy just prints money as an influencer on YouTube, right? He's in the 1% class. There's a vast majority of people that don't make that kind of money, but we all aspire to be in that 1%. So we all assume that, hey, if we just do these things, that we're going to get the same results, and that's not necessarily the case. And so we wind up taking on way too much risk, start buying penny stocks, start buying meme stocks, whatever it is, because crypto stocks, and as long as it's working, it's fantastic until it doesn't.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
If you're 65 in 2025, Medicare will be a part of your life from now on. What do baby boomers need to know about Medicare? Richard Rosso and Danny Ratliff present our next dynamic learning series on Savvy Medicare Planning. Thursday, September 18th, with answers to your questions about Medicare, when to enroll, and how to navigate the alphabet soup of Medicare. Register today for Savvy Medicare Planning, what baby boomers need to know about Medicare. September 18th with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
when everybody says you can put all your money into something, run.
Yeah.
I mean, that's your first instinct is run when somebody says that, because there is no investment you should have all your money in. And again, I was just, as I was watching chat. By the way, be sure and join chat, ask questions. I try to monitor it while I'm talking, but again, if y'all would be a little bit more focused, it would help me. Also, like and subscribe to the channel while we're here, and be sure and like. We got like 800, 600 people watching right now, and 100 likes. Come on, get some likes in the chat. It helps our algorithms to get our videos out there, and so Google will like us a little bit better. Your help is greatly appreciated. Like for instance, one of the comments is just buy VOO and chill. Right? VOO is just the S&P 500. That all sounds great, fine and dandy, and I will guarantee you that the person that wrote that is probably younger. If you went in the markets from 1999 through 2013, you made no money owning VOO for 14 years. That's an inflation-adjusted basis. Took you till 2017 on a nominal basis to get back to even. You can go very long periods of time. This idea of just buying an index and it all working out fine and dandy is great if you start that process with valuations low. If you're starting that process today with valuations, at near the second highest level on record, your outcome potentially is going to be much different than what you're expecting. So having all your money in an S&P index fund, it sounds great until you wind up losing 30, 40, 50% of your money. It's not so great when that occurs. So having other alternative assets in your portfolio, whether it's an annuity, whether it's life insurance, whether it's bonds, whether it's private equity, private credit, whatever it is, this is why if you want to be wealthy, do what wealthy people do. This is why wealthy people don't have all their money in stocks. They have about 20, 25% in stocks. The rest of it is in real estate. It's in bonds. It's in cash. It's in private business, private equity. Generally, the private equity is the business they own. That's where their money is. They don't have a large chunk of their money invested in something that is totally risk-based, which is the stock market.
Well, that just reminds me. I had a client last night visited with their son. Just graduated college, has done an extremely good job of saving money. Like literally just graduated, has already saved, tens of thousands of dollars. So like kudos to him. Awesome. But he's putting everything into VOO.
Sure.
Which is great.
At that age?
At that age, right?
Yeah.
22 years old, you have a emergency fund. And so what he was starting to do is put everything into VOO. And I said, whoa. What happens if you lose your job? What happens if something happens at work, you're out of work for a while? Do you have short-term disability, long-term disability? I mean, all these extra questions. But we started talking about that, and he said, well, I really want, kind of stuff we're talking about. What about real estate? What about a duplex or apartments? I said, I think those are great, but here's where you need to focus. You can use this to your advantage, the volatility that we're likely going to see, because you're putting in $2,000 every month. That's great. So you're actually going to be using this, and it's not your overall net worth. Now, what I need you to do is say, let's go ahead and put a little bit in cash. I know it's tough at your age. You probably don't want to, but as we're younger, we can afford to be much, have a higher concentration. We just want to have a minimal amount for if you lose your job, something happens, the market's down 20%, you're not getting, pulling everything out at much lower prices. If you got to do it, you got to do it. But overall, the key here is that him versus his parents may look much different. About to retire, ready to start winding things down. They're not 100% invested in VOO, and now they're about to become a distributor, not an accumulator. As you're an accumulator, that can work to your advantage. But for somebody who's older, now we can't go through that 10, 15-year period. And that period that Lance mentioned, that didn't mean that markets were down each and every year. They were down 2001, 2, 3. We were down in 2008, but those were significant. And so if you just rode it and you were taking distributions, now you never got back to even. Mm-hmm. And so that's where I think we have to be cautious. But so this gentleman was like, hey, I want to look at duplexes, apartments, all these things because, I'm hearing this is what the wealthy do and it's a great way to build wealth. I said, yeah, I don't disagree. But here's where we need to get you. Here's how much you need to save. So don't go and skip the building blocks build that foundation that's going to be solid. And from there, you're going to have a lot more opportunities that are going to be at your disposal. You're going to be saying, okay, hey, I can try this. I can start investing here. But you're not putting all of your wealth and moving it to somewhere else. Mm-hmm. And I think that's the key. You've got to do it in the right steps.
That's right. And again, this is all about investing and portfolio management and, financial planning, et cetera. And, all part of the process that, we work through with our clients. And the reason we're telling you this now is just, to share, what we've been, I've been through the dot-com crash. I went through the 87 crash. I went through the 2008 crash. I've seen real bear markets. I've been through real bear markets. And I know what the devastation looks like, not just to the economy and to the markets, but to individuals that we were working with. I saw people completely devastate their lives in 1999 because they were borrowing against all their credit cards to buy stocks on leverage. And, completely devastated them financially, period. I mean, there was no recovery.
They were taking home equities to buy Enron.
Exactly. That stuff happens. And it may not have happened in this market since 2009. And that's a very long time. We've gone basically 15 years now without any type of major event occurring. That's a pretty long stretch. Now, markets, bull markets can last, 20 years. And that's very common, 1980 to 2000, right? 20-year stretch, markets returned about 15% a year on average. It was fantastic. Couldn't lose. And then you lost. And so, just understand that, the stuff we're telling you is not because we're just being old baby boomers and, old guys and we just don't understand the market. We understand markets. We understand speculation. We understand risk-taking. We've been here. We've been through that. There is going to be another down cycle in the markets. Question is whether or not you can survive it. And that's what we're hopefully here just to help you kind of just realize some of the risk and don't take things for granted in this market, because the risk levels in the market are building rapidly, from speculative option trading to meme stocks to all these other type of things. Those are all the same signs that we saw back in the late 90s that occurred in the market. Same thing we saw really in 2006, 2007 in regards to real estate. That same type of activity is occurring again. So we just want you to be careful, be knowledgeable. That's all we're trying to do here, and just help you manage your own money better. If you have questions, like Danny said, get by the website, realinvestmentadvice.com. There's an ask a question button right on the page. Comes right to my desk. We answer every question every day. So happy to do it. Anything we can help you with, happy to do it for you. So just let us know, realinvestmentadvice.com. Make sure to like and subscribe to the channel. Again, really, really, really helps us out a lot. Follow me on X as well as at Substack at Lance Roberts. Get all of our latest articles, our posts, everything delivered right to your email. It's all there for you, and we're happy to help you. See you tomorrow.